This is not just a story of missing money. It is a story of corporate governance, boardroom dynamics, risk management. Welcome to Capital Counsel. I'm your host, Nina City. Today we are going to explore one of the most significant governance failures in the Kenya's financial sector. The collapse of confidence at KUSCCO has become one of a topic or a study in the universities, and not just something to talk about. It is something that you can write a thesis on, you can write a book on, and you can try to decipher what really happened in terms of corporate governance. This is not just a story of missing money. It is a story of corporate governance, boardroom dynamics, risk management, internal controls, ethics, accountability, name them, all this in the board. Every director, company secretary, managing director, CEO and board members, and you watching me, should pay attention. So, KUSCCO was established to support and manage the SACCO systems in the country, the Kenya's SACCO movement. So that is why KUSCCO was established. The trust was built on one simple expectation: to promote professionalism, to promote trust, transparency in the SACCO sector. However, forensic investigations later on came out and gave their report on matters of weak governance structures, irregularities in payments, there were missing monies and all that. And you know, this was a big scandal in the Kenyan news and the Kenyan financial sector, and you must have seen it. And people even went on to panic and decided, you know what, I am not going to save in SACCOs, because some SACCOs had saved their money with KUSCCO. You feel the pain? Your money might have been invested in KUSCCO. So what happens next? Is the SACCO society? So these findings from the forensic investigations shook the entire SACCO movement, because now SACCO started asking critical questions. And I always say we should ask questions. What happened? Where was the board? Who is the responsible? What remedies do we have at this point? And all that. That was the committee, especially Audit and Risk Committee. What were they doing? They have a mandate. What were they doing? So one of the misconceptions in corporate is that directors run the companies. They don't. Management run the company. Directors oversee. Their work is to oversee. And that's why most of the time you find that company, or not always, you find that companies have board charters. And what is the reason of having these board charters? It is to ensure that there's separation of powers, so that there's no given time where the board is meddling in the affairs of management. This way, they allow the management to run the company smoothly, but however report to the board, and board provides an oversight to management. So why is this difficult to accept, that this KUSCCO actually went under? It is because they are expected, the board of KUSCCO was expected to oversee, to ask questions, not to just receive reports and endorse and acknowledge everything, because there's a sitting allowance after all. And anyway, not all board pay sitting allowance. Some board members work out of passion, and so they're supposed to ask questions. If the numbers are not numbering, they're supposed to ask these difficult questions at this time. But did they? You guessed it right. So directors are not expected to be accountants. But if you ask me, under the listed companies, you find that the audit committee must have somebody who really understands the numbers, who is a CPA, who must be a CPA, and they're all independent directors. So they do not have any interest in the company other than protecting the minority shareholders. But now, in the case of SACCO, were they independent? Did they understand the monies, the financials and all that? Where was the auditor? Internal auditor? What did the external auditor say? Is he still running in the market? Is he still supporting other SACCOs, other companies of merit? Because after the the forensic investigations, this was unveiled. One of the things I'll tell you as a board member or an aspiring board member one in time, you should never accept accounting reports if you do not understand them. Let it take a day, a full day. Take time even before, because you receive those board packs beforehand, before the meetings. So you have time to really go through the reports. And if you don't understand, you can ask questions at that point. And even in the board meeting, you still come back and ask questions. If something appears too good to be true, please investigate. Do not just let it slide and say the company is doing wonderful. Do not. Another lesson I get from this scandal is that internal auditors should never be part of the management. Internal auditors should always report to the board, a dotting line to the CEO, but report directly to the audit committee of the board, because they are responsible to providing independence assurance to the board and to the entire company. So if they report to somebody else internally, then likely there might be interference. So it is always good practice for internal auditors to report directly to the audit committee. So you might ask, because through my interaction with other diaspora people, I got to understand that Kenyans, we have very beautiful policies, very wonderful documents, step by step on how to do and achieve things. But yet we still see scandals about failure in governance, failure of companies, and then later on, majority or 99% you find that it is usually corporate governance failure in these companies. So you may ask yourself, why does this happen? Because I'll tell you this, because governance is all about culture. Governance is ultimately about culture. If the employees fear speaking up, if executives discourages criticism, they are bound to fail. If whistleblowers are ignored, they're bound to fail. Culture is an invisible system control. You might not see it, but it will happen. So governance is changing rapidly, and the board needs continuous training, and I am happy because you see, for listed companies, they have a mandatory 12-hour training per year. So no one will say that they did not have time to attend any training, because today you can attend a 1-hour training, 45 minutes training next month. So throughout the year, you find that the continuous training has been achieved, and you have a better, and this can be in cybersecurity, anti-money laundering, especially now since Kenya is grey listed and we want to come off the hook. So anti-money laundering, corporate governance, data protection, ESG reporting, climate risk, because that is very essential, especially now. And now we have IFRS 1, S1 and S2 reporting, which is becoming mandatory for all listed companies, and eventually I know it will trickle to other companies. So those are the issues where they can be trained on the enterprise risk management and all that. Many training that are relevant to the organization that you work for or you sit in their board. Questions every board should ask today. So if your board met tomorrow morning, would you be confident answering these questions? Do we understand every major financial risk? Are we receiving independence assurance? Would we detect fraud early? Does management feel comfortable reporting bad news because it's not always rosy? Would our governance withstand forensic audit? So these questions that I've just mentioned separate compliant board and effective board. In finishing, I would say KUSCCO's crisis should not be viewed as someone else's problem. It should be seen as every institution's lesson. Whether you serve on a listed company on the Nairobi Securities Exchange, a pension firm, just another corporate entity, a government-owned entity, a university, a family-owned business, the principles remain the same. The strong governance protect institutions, weak governance destroy them. And remember, good governance is not an expense, it is an investment in trust. If you found value in today's episode, kindly share with fellow directors, company secretaries, board members, you and I, and anyone interested in corporate governance. A board's greatest asset is not a balance sheet. It is confidence that stakeholders places in its leadership. Till next time, I am Nina City. Bye.